Hey and welcome back to YT Finance, and today we are talking about the best stocks to buy right now. It's been an exciting start to the year, but we've hit a bit of a bump in the road. Every major US stock index has taken a bit of a dip in February, thanks to stubbornly high inflation. Experts are predicting that this could lead to some aggressive interest rate hikes by the Federal Reserve later this year. But don't panic, there's still hope for us stock investors. In fact, defensive stocks are looking like the best bet in this kind of environment. These are the types of equities that are less sensitive to macroeconomic factors, so they tend to have fairly stable price performance in both bull and bear markets. And lucky for us, I've got 3 top defensive plays that you should definitely consider buying right now. Let's dive in and secure those gains. Let's start off by talking about Eli Lilly, ticker symbol LLY. This megacap pharma company is an absolute powerhouse. As a top-tier healthcare company, Lilly is seen as a high-end defensive stock because people rarely skip out on life-saving medications. In 2022, the company's shares skyrocketed 32.4% thanks to its impressive organic growth, top-notch clinical pipeline, and a shift towards safer investments by investors. But what about this year? Well, Lilly has seen some ups and downs. Although the stock market is off to a rocky start in 2023, Lilly's shares have underperformed due to its higher price tag, a small miss on quarterly sales for its new diabetes drug, Mounjaro, and a temporary trend away from defensive stocks. But don't count this company out just yet. Eli Lilly is a solid player in the healthcare industry, and with its strong track record, it's definitely one to watch for long-term growth. This company is poised for a healthy rebound over the rest of 2023. Defensive stocks as a whole are expected to bounce back thanks to a sizable interest rate hike on the horizon. And that's not all. Mounjaro, Lilly's diabetes drug, is expected to see a big jump in sales this year thanks to broader insurance coverage and the possibility of a weight loss label expansion. Plus, there's more in the pipeline. Experts predict that Lilly could score some major approvals in immunology and dermatology that could really boost its growth. And let's not forget, Lilly has a recession-proof business model and a stellar long-term outlook that bode well for its future beyond 2023. So hold on tight, because Lilly is definitely a stock to keep your eye on. Now let's talk about Lockheed Martin, ticker symbol LMT, which is a major player in the defense industry. Last year, investors went wild for companies with businesses that aren't impacted by economic ups and downs, and Lockheed's shares rose an incredible 36.8%. But this year has started off on a bit of a rocky note. The stock has dropped by 2.23%, due to investors' initial optimism that the Federal Reserve would slow down on future rate hikes. But let's face it, hot inflation, more rate hikes, and a possible global recession are 3 reasons why Lockheed's stock is primed for a comeback. As a major defense contractor, this company is a great pick for those looking to weather any potential economic storms. Lockheed Martin could be the perfect stock for your portfolio in 2023 and beyond. With approximately 70% of its annual revenue coming from contracts with the US Department of Defense, this company's core business is as predictable as it gets. And that's not all. Lockheed's F-35 program is expected to generate significant revenue all the way through 2070. That's a long-term revenue stream that any investor would love to have. And as if that weren't enough, Lockheed also offers an above-average dividend yield of 2.52% at current levels. Now that's what I call a solid investment opportunity. Next up we have Verizon. This large-cap telecom company is renowned for its reliability and investment in network strength. Although a potential economic recession could lead to customers migrating to low-cost carriers, Verizon's operational efficiencies and scale should help mitigate the impact on profitability. While the company's top-line growth is expected to be modest, with only a 1.1% increase in sales forecast for 2024, Verizon offers an annualized dividend yield of 6.49% and is currently trading at under 9 times forward earnings, making it an enticing investment option in the current turbulent market. However, due to the unpredictability of the telecom space, Verizon is considered the riskiest of the 3 defensive stocks that we have mentioned so far. Up next on our list, we have The Trade Desk, which is a standout in the ad tech industry. Its independent business model means it has no incentive to favor specific inventory, making it a more reliable option for advertisers. And with revenue climbing 24% to $491 million in the fourth quarter and GAAP earnings of 14 cents per diluted share, up 7-fold from the prior year, The Trade Desk is taking market share quickly. Even more impressive is that it's outpacing industry leaders Alphabet and Meta Platforms, both of which reported a 4% decline in fourth quarter ad revenue. Despite the recent market volatility, The Trade Desk is a standout in the ad tech industry. Not only did the company deliver impressive financial results in the fourth quarter, but it's also taking market share from industry leaders like Alphabet and Meta Platforms. The company's independent business model means it doesn't have any incentive to push specific inventory, unlike its competitors. But what really sets The Trade Desk apart is its advanced technology. According to management, The Trade Desk has the most advanced data marketplace in the industry and an unmatched artificial intelligence engine. This allows advertisers to target ads and optimize campaigns more effectively, leading to better outcomes. And don't just take their word for it. Consulting company Quadrant Knowledge Solutions recognized The Trade Desk as the leading ad tech platform based on its customer impact and superior technology. Now, here's the exciting part: the digital advertising industry is on track to become a $1 trillion market. And with shares of the trade desk currently trading at a discount to their 3-year average, this growth stock is a screaming buy. Now let's talk Shopify. Sure, the fourth quarter earnings report wasn't as exciting as we'd hoped. But don't panic, there's still plenty to be excited about. Shopify is a top player in the US e-commerce industry, with a 10% market share right behind Amazon, which accounts for a whopping 38% of digital retail sales. And with e-commerce expected to reach $15 trillion by 2030, Shopify has plenty of room for growth. What sets Shopify apart from the competition is its innovative platform. It simplifies commerce and empowers merchants like no other, integrating physical and digital sales channels under one dashboard. That's why it's the market leader in e-commerce software. Plus, Shopify is leaning into its strengths by rolling out the Shopify Fulfillment Network, which streamlines the supply chain, making it easier for businesses to manage inventory and fulfill orders. Sure, this logistics push may put some near-term pressure on margins, but the long-term value is undeniable. Shopify's SFN will support 2-day delivery across multiple sales channels, which will draw more businesses to the platform. And let's not forget that Shopify trades at an absolute bargain, with shares at 9.3 times sales compared to the 3-year average of 34.2 times sales. That's why now is the perfect time to buy this growth stock. Next up, we have exciting news for investors. In the wake of the Ukraine conflict and global energy market disruptions, Enterprise Products Partners ticker symbol EPD is stepping up to the plate, providing dependable and economical power sources to meet the world's energy needs. With an impressive network of pipelines, storage sites, processing facilities, and deep-water docks, Enterprise is a powerhouse in transporting essential resources such as oil, natural gas, liquefied natural gas, and petrochemicals across the US. And the best part? Enterprise is highly profitable, with an average return on invested capital of 12% over the past decade. But that's not all, this master limited partnership is also a cash flow champion, boasting a 17% increase in distributable cash flow to a whopping $7.8 billion in 2022. And for the 24th year in a row, Enterprise has boosted its cash distribution with a well-covered payout. Plus, with its latest increase, Enterprise's partnership units now offer income-seeking investors a mouthwatering 7.4% yield. So get ready to cash in on this energy giant. Next up, we have got another exciting investment opportunity for you, which is none other than Brookfield Infrastructure Partners, ticker symbol BIP. The company goes beyond energy to transport essential cargo like people, freight, and data. With its impressive toll roads, railroads, and telecom towers, Brookfield's revenue is often locked in with long-term contracts, making it practically recession-proof. And with inflation adjustments included in these contracts, Brookfield is especially well-positioned to thrive in the current rising interest rate environment. But that's not all, Brookfield is highly selective when it comes to investing, targeting returns of 12% to 15% on the capital it deploys. And it's certainly risen to the challenge, growing its funds from operations at an impressive 11% compound annual growth rate over the past decade. This growth has allowed Brookfield to raise its cash distribution to investors by 9% annually during that time. And the good news doesn't stop there. Brookfield believes it can continue to grow its payout by 5% to 9% annually in the coming years. Plus, with a roughly 4% yield, investors can earn passive income just by buying shares of this infrastructure giant today. So what are you waiting for? Check out Brookfield Infrastructure Partners and watch your portfolio soar. Now, if you're looking for a stock that delivers steady, reliable passive income, look no further than AT&T, ticker symbol T. This wireless leader pays a whopping dividend that yields an impressive 5.7%. After a media empire-building spree failed to produce the intended gains, AT&T has shifted its focus back to its core telecommunications business, and the results are paying off big time. Thanks to its customer growth in wireless and broadband internet, combined with cost-cutting measures, AT&T is now producing even more cash flow. In fact, the telecom titan expects to generate at least $16 billion of free cash flow in 2023 alone. And that's not all, this cash flow is more than enough to cover AT&T's dividend payments twice over, providing investors with peace of mind. The remaining cash can be used for value-creating purposes like debt reduction and share repurchases. Plus, with increasing demand for high-speed connectivity services driving its subscriber growth, AT&T is poised to keep delivering robust returns to its shareholders. So don't wait, add AT&T to your portfolio today and watch your passive income grow. Next up, we have Petrobras, which is experiencing a number of positive developments that are pushing its business forward. The company's debt-reducing measures have significantly improved its capital structure, while the increasing price of oil has led to a surge in free cash flow. On top of this, Petrobras has implemented a disciplined capital allocation strategy and is in charge of Brazil's low-cost supply pre-salt reservoirs. Even more impressive, analysts on Wall Street believe the company's stock is undervalued by up to 16.2% compared to its current level. Petrobras is, in fact, the only major oil and gas producer trading below analysts' fair value estimate at present. But what's the catch? There is a notable level of uncertainty surrounding the company's future following the election of President Luiz Inácio Lula. As a state-run entity, Petrobras is susceptible to changes in its capital allocation strategy and operations, which is a major risk factor that caused the company's shares to underperform in a market that has been highly favorable to top-tier oil and gas firms over the past year. Our next stock is Zim. The Israeli cargo company is having a great start to the year, with its shares surging by an impressive 26.7% in the first 2 months of 2023. The company's stock experienced a dramatic increase in value during the pandemic as global freight rates soared. However, in 2022, Zim's shares plummeted by 70% due to a decline in freight rates and concerns over a looming global recession. But now, thanks to a positive note from JP Morgan analyst Samuel Bland, the company's shares are soaring once again. Bland believes that the market has unfairly punished Zim's stock, given the strength of the company's balance sheet, which can weather mild economic recessions. Additionally, Zim's shares are trading at only 0.43 times trailing 12-month earnings, making them an attractive investment opportunity. While the global shipping industry may experience a downturn in 2023 to 2024, this bearish sentiment could be overblown at this point. Get ready for your caffeine fix because Starbucks is once again in growth mode and has reported a record-breaking revenue of $8.7 billion in the first fiscal quarter of 2023, marking an 8% year-over-year increase. Even with stores closed in China, its second-largest market, for part of the quarter, the company managed to post impressive numbers. US comparable store sales grew by 10%, while international comps decreased 13%, and China's comps were down 29%. But that didn't stop consumers from indulging in their daily cup of Starbucks coffee, as the company's affordable luxury remains a staple for many. Notably, Starbucks even raised prices in some North American markets to offset increased costs, resulting in earnings per share increasing 7% over last year to 74 cents. Retail spending has been on the rise lately, and Starbucks is poised to take advantage of this trend. The company opened 459 stores in the first quarter, ending the period with over 36,000 stores, with roughly half of them located in North America. And with plans to open another 3,000 stores annually over the next 3 years, Starbucks aims to have 45,000 stores in operation by the end of 2025, presenting plenty of cash-generating opportunities for investors. The cherry on top? Starbucks offers a high-yielding, stable, and growing dividend, currently yielding 1.9% at the current price. So, for investors looking for a reliable source of passive income, Starbucks is an excellent choice. Up next we have PepsiCo and Coca-Cola, which are often compared to each other, but there's a crucial difference between them. PepsiCo is more than just beverages. The company's name might be synonymous with its flagship beverage brand, but PepsiCo's separate snack and breakfast segments make it a bigger player in terms of revenue. In fact, in 2022, it generated twice the revenue of Coca-Cola, $86 billion versus $43 billion. This diverse business strategy helped PepsiCo weather the storm during the early days of the pandemic, when people stayed home and snacked on chips and cereals. And it provides a cushion for the company in any environment, with various revenue streams contributing to robust sales. Like Starbucks, PepsiCo has successfully increased prices to offset higher costs, leading to robust growth in the fourth quarter. Sales surged by 11%, and organic sales jumped 14.6%. Net income was still under pressure, but core earnings per share from core products climbed 10% from the previous year to $1.67, and management expects this pressure to continue in 2023. PepsiCo is aiming for 6% growth in organic revenue and 8% growth in core EPS. While the company's pricing power has limits, its resilient operating model and strong cash generation should provide years of dividends for shareholders. PepsiCo is a dividend king, having increased its dividend annually for the past 51 years. The dividend currently yields nearly 2% at the current price, and it's a reliable choice for investors seeking stable, long-term growth. Lastly, we have Target, which has been a standout performer throughout the pandemic, but the current environment of inflation has brought some challenges. Despite this, Target's strategic shift towards an omnichannel shopping experience with same-day services and competitive prices. Target is well positioned and it is a leader in the essentials retail sector. In Q3 of 2022, comps were up 2.7%, and although EPS declined 49% to $1.54, Target's core categories continue to perform well, proving its value to customers. To prepare for the future, management is implementing a 3-year cost-saving plan, aiming to save between $2 billion and $3 billion. Target may be experiencing a temporary setback, but don't count it out just yet. This dividend king has raised its dividend annually for the past 51 years, including a 20% increase in June. Target's dividend currently yields at 2.46%, and investors can continue to expect reliable passive income for many years to come. Thank you for watching this video on the best stocks to buy right now. For more videos on the best growth stocks and the best dividend stocks to buy right now, go and smash the like button. I also want you to comment down below if you own any of the companies that were mentioned on this list. Thanks again for watching, and we will see you in the next YT video.